Hey traders, this is Blake Morrow with Trader Summit, and with me today I have Mr. Jim Welsh from Macro Tides. He's with us. Good afternoon or morning or whatever it
It's
is.
Friday, and
It's
even though it's
Friday.
a 4-day work week, sometimes there's more happens in 4 days than 5 days, and it's like,
Right,
thank God it's Friday.
right. Thank God it is Friday. So welcome back, Jim. And hey,
Yep.
before I forget this, I know next week you're going to be out on vacation or holiday. So you're not going
Yep.
to be with us next Friday. So realistically, we're not going to talk until after the FOMC. So
Yep.
with that being said, what words of wisdom do you have about the Fed and
Yeah.
expectations between now and then?
Well, I don't think they're going to raise the funds rate at the September meeting. No,
Mm,
no big deal. I
yeah,
do think that Powell will endeavor to keep what they'll do at the November 1st meeting as a live meeting. We're data dependent, and we're going to talk about the CPI in a few minutes. So I think that will be one of his emphasis is that November 1st may or may not include a rate increase. The dot plots that the Fed will provide, they do it every 3 months. So the last time was in June. So they will do it again at this September meeting. It's a composite. They come up with what is the median projection. And
yeah.
I think there's a couple things. In June, they thought GDP would grow 1% in 2023. Well, we've had the first 2 quarters are north of 2%. The third quarter is going to be pushing 3%. So they're going to double. They're going to raise that to at least 2%. But I think the markets are going to be really keying off of what tweaks do they provide regarding the Fed funds rate. The target rate was 5.6. So do we have a few more hawks on the board so that might tick up a little bit from 5.6 to 5.7? And I think there's a positioning thing for the Fed that let's convey that we're tough. We're going to keep fighting the good fight. And I think ticking that up from 5.6 to 5.7 is, again, a reinforcement of the idea of, hey, we're not done with rates. Just because we skipped in September doesn't mean that we won't be raising rates at a future meeting.
So Jim, if I hear what you're saying, but do you think if the CPI data comes in hot next week, do you think that could influence the Fed to actually raise rates this month?
No,
So
no.
you
Again,
think it's
I
off
think
the board no matter what?
pretty much, yes. Because let's think about it. What the Fed did is, last year they had 375 basis point rate increases. Then they downshifted to 50 basis points. Then they did 25. And then they started to skip a meeting. And I think that's the template that they're working on is that, all right, we're getting closer and closer to that restrictive level. We have no way of precisely measuring it. Plus, we're looking at data that's 6 to 12 months old in terms of the impact on monetary policy.
Yeah.
So I just think they're at that point where it's like we're skipping every other meeting, which again leaves November 1st open as a live meeting. And I think the CPI will reinforce that, yes, it is an open meeting, and it'll make it easy for Powell to make that comment.
Got it. Okay. Well, so next in 2 weeks is off the table. Got it. Moving on. And actually, we might as well just jump into some of these charts that you brought.
Yeah.
Going into next week, this is going to be the first thing you want to talk about is inflation. CPI is next week. It feels like volatility has been a little low this week, but we should have people really paying attention to what's happening with inflation next week, right?
Yeah. I mean, you and I have done this periodically over the last 6-8 months. The idea was, hey, we're going to see inflation come down more than expected. That should be positive, and so forth. Now, last month it was like, nope, we're going to see the opposite. We're going to see inflation tick up. It did. And the risk, Blake, is that we're going to see even a larger tick up for August. So let's very quickly, the CPI is a 12-month rate of change. So they're subtracting the 0.12 from August of last year, and then it's whatever the monthly increase for August of 23 that gets added in. So I think there's the potential that the month over month number will be up 0.4, 0.5. The Cleveland Fed, their estimate is 0.8. All right, so let's say it's 0.5. Well, that means we're going to subtract 0.1 and we're going to add 0.5, which means the annual year-over-year rate is going to tick up from 3.2 to 3.6. So to me, that headline increase, again, is going to get, I think, markets to, if you will, say, whoa, wait a second. The Fed is even more likely to move in November. And so watching what the Fed funds futures are saying in terms of the probability of a hike in November, I just think that the narrative that we've had for much of the last 8 months, inflation coming down, the Fed's almost done, this is a fly in the ointment in terms of easy peasy. Inflation isn't going to come down maybe as quickly as people expect. The point also I would make is the core rate will probably decline.
Okay.
So, because the takeaway value in the core, I can't remember if it's 0.4, 0.5. So I think, again, what we're going to see is the headline is definitely ticking higher, and the core rate might tick down by 1 or 2 tenths. But the headline, as we know, the newspapers next Thursday morning are inflation picks up, worries mount about Fed tightening. So how the markets respond to this will be pretty instructive. And I think as we'll review some of these charts, I think they're going to react more often. I think they're going to react negatively.
What if the Cleveland Fed is spot on with their
Wow. Well, that's a shocker.
Well, yeah, it's a shocker, but let's say they're right. They are the Cleveland Fed. Let's say they are right.
Yeah.
Do then, does the Fed actually move in 2 weeks?
I don't think so.
Okay.
I really don't. I mean, again, I think they've got this template. In other words, Powell reached an agreement between the Doves and the Hawks a couple meetings ago. And that was, all right, we're going to increase the funds rate. I think, was it in June? Yeah, but we're not going to do it in July, or we'll do it in May, but not in June, then again in July. I can't remember all the detail. It's Friday and I'm tired. So, but I think that was the agreement that was like, okay, we're going to nudge our way up and keep the potential of future rate increases on the table and communicate that clearly. So I just think that overall, more of them are ready to like, okay, it's time to be patient. We can wait a little bit longer. We're going to get another CPI report, another PCE report before the November meeting, and we'll see how those numbers come in. So,
all right. Well,
even if the Cleveland Fed is right, I really would be very surprised if the Fed reacted to that.
Okay. All right. Well, let's take a look at how the markets might react, because the first chart you brought is the S&P, and this is like a short-term count, right?
Yeah, it is. And basically from the low we saw on August 18th at 43.35, the question I raised last week, hey, the market's at a crossroads here. Either we're going to get a little dip and then another push above 45.41 to complete 5 up from 43.35. My inclination was that we were likely to see a deeper pullback, and that once the S&P overlapped 44.58, you could no longer count that as 1, 2, 3, 4, 5. So it's an ABC. Then from that high we saw on August 1st at 45.41, it looks pretty clean. 1, 2, 3, 4, 5 to the low this week. So what, to me, the bigger picture, so we're going to get a bounce short term. And that's why I have wave 1 down. And then we're getting this wave 2 bounce. So the next chart takes a bigger view and putting it into
this is an inverted head and shoulder pattern for you tech people. You guys technicians.
Yeah. So okay, so this, I think a 618 of the decline, the S&P dropped about 110 points. 618 would be 66 points. All of a sudden you're at what, 4490, 4500.
Yeah.
And you can kind of see how the S&P held for a couple of days just over 4500 before Wednesday it took the dump. So so to me, that's my expectation, is we're going to get this bounce. And then what happens next is on the next chart.
There we go.
Okay. So again, bigger picture from the high 46.07. As far as I can tell, that's 3 waves down to the low at 43.35. So the question last week was, that all the correction, or is there going to be a bounce and then another correction? And to me, the S&P pattern has suggested, yes, we are going to take out 43.35. You have three waves up into that high at 45.41. I think that's wave B. We have 1, 2, 3, 4, 5 down as we showed on the prior chart. I think that's wave 1. The bounce we're seeing now is wave 2 of wave C. And if C and A are equal, it targets 4270 on the S&P. So, my take is I think over the next week or 2 weeks, we're likely to see the S&P drop. Again, a hot CPI, even if it isn't the Cleveland Fed whopper number, yeah. I think it, adds pressure on the narrative like the Fed is done, and that's all I can. And again, I'll go back to this. The Fed, if they're done, Wall Street is still pricing in 3.5 rate hikes next year. I honestly believe that's unrealistic. In other words, first of all, the Fed raised the funds rate 525 basis points, but we're not going to have a recession. All right. That's kind of amazing. All right. That we're not going to have any meaningful economic repercussions from that type of a sharp increase. And then, since we're not going to have a recession, despite that, the Fed's going to be cutting rates next year, even though the unemployment rate's not that far from a 50-year low and so forth. So to me, the whole idea here that the Fed may be done and all that, it's missing the bigger point that the Fed isn't cutting rates anytime soon. And the drag effect from all those rate increases, I continue to believe, is going to slow the economy materially in the next 3 to 6 months. So in the short term, that hot CPI kind of puts a dent into that whole narrative that, okay, the economy, no recession, the Fed's done, and that's going to be great, and they'll be cutting next. Oh, wait a second, a hot CPI. All of a sudden, I think the market has a reaction to the downside. The price pattern with the 5-wave decline that we've seen from the high at 45.41, suggests to me that the next move after a bounce that maybe carries into early next week is going to be lower.
Yeah, that makes sense to me too, Jim. The next chart you brought is Treasury yields, and what are we looking at here?
Okay, the one thing, I talk about intermarket divergences. So back in February, March, and April, if you look at the left-hand side of the 10-year Treasury, you'll see that it made a low in February at 333. And then in March and April, it got down to 325 or whatever, So you can see the 10-year made a lower low. You look at the 30-year, the low in February was 348 and change, but in March, it was higher, 352. That was one of the signals that said, hey, you know what? Intermarket divergence, a negative one. This suggests that we're going to see yields move higher. So now what I'm looking for is one of the signs that yields have stopped going up is potentially that we see, whether it's next week or sometime in the not too distant future, either the 10 and 30-year take out the high we saw from last week on each of their instruments, with one or the other not making a higher high. That would provide me a lot of conviction that, all right, the table is now set for yields to come down. And of course, you need yields then to roll over and start to come down, if you will, to seal the deal that positive intermarket divergence is in place. Sure. I think, just simply 411 is a big number on both the 10-year and the 30-year. That's where that horizontal line is driven, the black one, where they broke out from. Next Wednesday, the CPI, if it comes in hotter, my expectation is we'll see yields tick up, and now we'll see whether or not that intermarket divergence can develop or not. Again, since that April low, higher highs, higher lows. So the trend for higher yields, that's what we're looking at. Now it's a question of, can we identify a turning point where yields can be confidently expected to decline, and we're not there yet.
Definitely not there yet, and that's probably one of the things that's weighing in on the dollar. And here's the dollar, and the dollar continues to grind higher this week. It's getting into that it hurts territory if you're short dollars, right?
Yeah, and I think that there's no question that some short covering has played a role. We're also coming into the area of resistance going back to the high in early March. late February. The RSI, that bottom panel shows that, hey, the RSI is nugging around 70, so it's getting overbought. To me, I think again, how markets react to news sometimes tells you more than the news itself. If I'm right and the CPI comes in a little hotter than expected, and that causes people to think, well, maybe the Fed will go in November, the dollar would get a lift from that. But I think it's a lift where we're near a high. It's my expectation that from the low under 99.57 or whatever that low was in July, I think we're nearing wave 5. 1, 2, 3, 4, 5. What that implies is we make a high in the not too distant future, get a pullback, and the pattern really implies, though, that after any pullback, the dollar is going to go even higher. Now, that could be obviously due to monetary policy. It could also do because the European economy is in a recession, and they're, that makes a difference.
Yeah.
It also could be to a geopolitical event, So I don't want to read too much into it, but right now, to me, near term, in July, you and I were talking. It's like, hey, we're going to see a rally. A lot of shorts out there and so forth. The expectation was at least up towards 104. If it got above 104, then that opened the door to the 105.50 area, and we're almost there.
All right.
So,
yeah, I mean, we are, Jim. It's been a bloodbath if you've been short dollars for sure. All right. Well, and with a hot CPI next week, if that does happen, the dollar, could continue to press. So what's that do for gold? Because gold has, I have to say, it's held up pretty well here with the dollar as strong as it is.
I agree. I mean, again, the bigger picture is 5 up from last September's low to the high in May. I think that suggests that the longer term trend is up. We're going to see a breakout above 2070 at some point in time. We're looking at a wave 2, and it may be done. I still think the odds are that the gold is going to drop below 1885, which was the low a couple weeks ago, and potentially under 1850. Now, to your point, Blake, if the CPI comes in hot and the dollar pops, to the target range that we talked about, and gold continues to hold above 1885 and then reverses and takes out that downtrend line, hey, I think you'd have to buy it on that breakout. So for me, gold is in a position of under 1850, look to be a buyer, and above that trend line, look to be a buyer.
Well, very good. Jim, I have an interesting look. This was one of my charts of the day earlier this week, and this all in all, technically could end up being, a wedge, and a wedge would, ultimately mean a bullish breakout as well. So, I think it's interesting how gold is finding and fitting that narrative that you've been so adamantly saying that, hey, on this next pullback, if we get into the 1800s, 1850, it's going to be all-time highs. So I think it's really trying to play into that.
We shall see.
We shall see.
Again, if you get a hot CPI, it would be classic. The dollar strengthens, that gold pukes, takes out 1885. The idea being, hey, we get a big tick up in inflation, and gold can't rally on that. Oh, geez, throw in the towel a little bit.
Right.
That'd be a classic type of thing. Take out that support, hit some stops, flush it down, and then that would be an ideal setup, I think.
That really would. All right. Well, Jim, let's hope that's what we get. And now we have a couple of weeks to take in some of your analysis before you come back from your holiday. What's the best way for us to follow your work? I mean, I want to know more about Jim Welsh.
Yeah. Macrotides.com, and then send me an email, jimwelshmacro@gmail. I'm happy to send out a recent publication, which will, give you, I think, a better handle of how I integrate fundamental analysis with technical analysis. So,
and make sure you guys do
on
that.
The offer.
And make mention that you saw Jim here on the Traders Summit, and you get a discount.
Please.
And Jim, I have to also say that you're really good about sending your clients, when there's a big, like, you guys got to see this. You update your clients just randomly when there's
Special
some
report,
biggest
special updates.
special updates.
Yeah, I
It's
mean,
it's like
again, the
breaking
weekly
news.
report. Yeah, the weekly report. I mean, the monthly takes a bigger picture. The weekly obviously is more detailed, especially from a technical standpoint. But when markets kind of fulfill something I've been looking for, I try to send out a special report and say, hey, now's the time to do such and such, whether it's to buy something or sell something.
Hey Jim, earlier you were mentioning that that if the inflation data comes in hotter than expected, the news stations would sound a certain way. What would they say?
Headline inflation ticks higher. Maybe the Federal Reserve will have to raise rates more.
Well, can you also say something about Peter Parker and Spider-Man? You sound like the guy from the news guy, from the show.
Yeah. Well, I've got 3 young grandsons, and one of them just loves Peter Parker. And one of the stories we read almost every time he's over for bedtime is the Peter Parker story. So I'm familiar.
Well, you for Halloween then you need to put on a costume of the reporter guy saying that you're searching for the Amazing Spider-Man. Anyway,
yeah, and look, thank you very much for that suggestion.
Jim, I want to say have a great holiday. We're going to miss you, but we're going to see you back here in 2 weeks.
Sounds good. Everyone stay well. Thank you, Blake.
All right, take care. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.